We all think we know how Warren Buffett invests. But what if I told you that when it comes to banks, he basically throws the standard investing rulebook right out the window? Well, today, we're going to crack open his secret playbook. We're putting one of the biggest banks in the world, JPMorgan Chase, right under the microscope, and we're going to use Buffett's own unique framework to see what he sees.
And wow, right off the bat, we run into a massive problem. I mean, look at this. On one side, you have all these analyst models screaming that JP Morgan's fair value is over $600 a share. But then you look at the reality. The bank actually lost or burned through $147 billion in free cash flow. So how on earth is that possible? How can both of these things be true? Are the analysts just totally off their rockers, or is this bank secretly just a giant cash-burning machine?
Well, here's the secret. That wild negative number, it's not a mistake at all. It's actually a clue. It's like a giant flashing neon sign telling us, hey, you're looking at this business all wrong. And you know what? Following this clue, that's the very first step to thinking like Warren Buffett. So let's really dig into this puzzle. Why do the standard tools, the ones that work perfectly fine for companies like Apple or Coca-Cola, just completely fall apart when we try to point them at a bank like JPMorgan Chase? Okay, here's the big misconception right here. You simply cannot, I repeat, cannot value a bank using a standard discounted cash flow model. And here's why. For a bank, cash isn't just the final product, it's the actual raw material of the business. Banks use cash to make loans, so a bank that's growing is often going to show negative cash flow because it's putting its money to work, growing its loan book. That negative $147 billion, that's not a sign of failure. It's a sign of a bank doing exactly what it's supposed to do.
All right, so if the standard investor's toolkit is basically useless here, what do we use instead? Well, we have to unlock Buffett's special toolkit, the one that forces us to ask completely different questions.
Buffett's number one rule for banks is actually pretty simple. Just ignore free cash flow. Throw it out. It's a total distraction. Instead, he focuses on two really fundamental things. First, what is the bank's actual real-world worth? And second, how good is the business at making a profit from that worth? That's it. So to answer that first question, what's it really worth? We use something called tangible book value. I want you to think of it like this. If JP Morgan just decided to close its doors tomorrow, sell off every single loan, every building, and then paid off every single debt, that pile of cash left over, that's its tangible book value. It's the bank's cold, hard liquidation value. Now for the second question, how good is the business actually? Buffett uses a metric called return on tangible common equity. And this is way simpler than it sounds. It just measures how much profit the bank can squeeze out of that pile of cash we just talked about. This is the ultimate report card for a bank's real profitability and its efficiency. Okay, so we've got our Buffett-style tools ready to go. Now it's time to put them to work. Is JP Morgan actually a good business? What we're really looking for is what Buffett famously calls a moat, that durable competitive advantage that protects its profits from invaders. Before we even touch the numbers, Buffett himself has made his opinion on JP Morgan's management crystal clear. He actually once said, I'd pay a premium for Jamie Dimon, who is the bank's legendary CEO. See, for Buffett, management isn't some fuzzy, soft factor. It's a critical piece of a bank's moat, and he is absolutely willing to pay up for the best in the business. Now, this is where it gets really interesting. Look at this number, 15.80%. This is JPM's return on equity. In this entire analysis, if you remember just one single number, please make it this one. This is the engine that drives the whole operation. But the real question is it any good? This chart just perfectly illustrates why that number is so fantastic. At almost 16%, it absolutely crushes the 4.5% you could get from a risk-free government bond. And even more importantly, it sails right over Buffett's own personal hurdle for a bank investment, which he says is around 12%. This right here, this is what tells him that JP Morgan has a wide, sustainable moat. And honestly, the supporting evidence is just overwhelming. I mean, an elite net profit margin over 20%? Check. 15 straight years of raising their dividend? Check. And they're doing it safely too, only paying out about 28% of their earnings. All while growing that dividend at over 14% a year, which just crushes inflation. This is the financial picture of a fortress. So, the verdict is in on quality, and it's a clear A-plus business. But, and this is a huge but, a great business can be a truly terrible investment if you overpay for it. So now we have to pivot and look at the other side of the coin. weighing the price against some pretty serious red flags. And right here, this is the central tension of this whole story. On the green flag side, yeah, its earnings yield of almost 7% looks way better than what you can get from bonds. But then, you look at the red flags. Its price-to-book ratio is 2.28. That's almost double Buffett's preferred entry point of less than 1.2. And a PEG ratio of nearly 6? I mean, that's something you'd expect to see on a high-flying tech stock, not a supposed value investment. The price, it seems, has all the good news already baked right in. And this brings us right back to Buffett's most important, most fundamental principle. It's not about making the most money possible. It's about making sure you don't lose it. This is his whole concept of margin of safety. You have to buy at a price that gives you a cushion, just in case things go wrong. And those red flags we just saw, they present a serious challenge to that principle. So what we have is an A-plus business selling at what looks like a C- price. Let's pull all the evidence from our little investigation together and deliver the final verdict. What would Warren Buffett actually do the JPMorgan stock today?
Okay, here it is, the final report card. Business quality, A+. The numbers just don't lie. Management, also an A+. Remember, Buffett himself said he'd pay a premium for them. But price attractiveness, oof, a C-. The stock is simply priced for perfection, and that leaves absolutely no margin of safety for an investor buying in today.
So, the final conclusion is actually a little nuanced. For a regular investor, someone like you're me, looking to start a new position, the verdict is pretty clear. Do not buy. The price is just too high compared to what the bank is actually worth. But for Berkshire, which already owns a ton of it, they should hold. It's a fantastic long-term compounding machine, and selling it just creates a massive tax bill. And for the true value hunter, the one waiting for what Buffett calls a fat pitch right down the middle of the plate, the move is to wait. You get interested when and only when the price drops enough to offer you that crucial margin of safety. And this whole exercise leaves us with one last really crucial question to think about. The market isn't wrong. JPMorgan is arguably the best-run bank in the entire world. But the lesson from Buffett's playbook is crystal clear. Buying the best business at a premium price is a quality investing strategy, not a value investing strategy. And that forces you to ask yourself, is that really a game you want to play?